Okay, I think we'll make a start there. So good afternoon and welcome, and thank you for joining the NSAW's Corporate Finance Update this afternoon. So I'll move on to content in a bit more detail shortly, but just in overview, what we're going to be doing this afternoon is having a little bit of time to reflect on what's happened in 2021 so far. We're nearly through the year, believe it or not. It doesn't seem possible. And then we're going to also try and look forward, maybe slightly dangerously, into what we think might be looking to happen in 2022. So we've got two of us on the call today. So myself and my colleague Simon, who's just thankfully appeared on his video. I was a bit worried there for a moment. So I will just skip a couple of slides. That's Simon and myself, and the picture's quite old. I've got a tie on that picture, if you see, and I haven't worn one of those for a couple of years, so it's definitely quite an old picture. So in terms of agenda, we chose to look at 5 areas, so all topical for us at the moment. The amount of deals that we've been doing, both locally and also looking at the picture across the UK. We're going to talk about responsible investing, which is very topical. We're going to talk about multiples, so valuations of businesses, broadly speaking. We'll talk about the types of transaction that we've been doing and the payment terms that buyers might be paying and sellers might be receiving right now. And for each of those areas, what we're actually going to do is we're going to, as I said at the start, we're going to look backwards, give you some observations, things that we've seen within our client base, some statistics on a national level. We're then going to, unfortunately, for those on the call, if you're thinking you're going to have an easy ride, we're going to do some polls, but they're really easy. So hopefully the technology works. There'll be some short polls in the middle of each of those sections. And then probably the most dangerous part of all, we're going to try and make a prediction going forwards as to what we think is happening in 2022. And it's very dangerous because we've already pre-populated those slides. So we'll see if we agree with you guys as we go along the way. There will be the opportunity for questions at the end. You can store them up and speak at the end, or you can put them in the Q&A as we go. So at that point, I will hand over to Simon to look at the first section.
Cheers, David. So the first area that we're going to look into is deal volumes over the last year. And this is a chart using data from Mark to Market of deal completions on a monthly basis using M&A mid-market data. And it's quite interesting because if you look between May 19 and March 20, so in the 11 months up to pandemic affected period, monthly deals were going along around 300, just over, and the average was actually 316, which is what that orange line is through the middle. So after March 20, we had a drop off for a couple of months. But then since September 20, every month since then has actually had more deals on a monthly basis than we had pre-pandemic, which is pretty surprising, really. You can see there's a bit of a natural curve there where it looks like it's dropping off over the months, not by March, but maybe 10, 20 deals a month. May or March even 2021 is huge, but that was driven by budget pressures and people worrying about CGT and what was going to happen. So if the data was rolled on for another month, but it's not available yet, unfortunately, October 2021 would probably be a similar story of quite a lot of tempo there. So probably not as high as March 21, but I guess probably about 500-600 I wouldn't be surprised to see for October 21. So in general, there's been a lot going on and a lot more than we would have expected if you'd asked us a year ago, is this going to happen? I don't think we would have said so. So it's been positive from that point of view. When we've talked about what we thought was going to happen a year ago, we thought that it was heavily going to be driven by sellers. So there was going to be so many people wanting to get out. Would there actually be enough buyers in the marketplace? And would that in turn push multiples down? What's actually happened since we made that prediction or observation is that there's been a lot more buyer-driven activity. So there's been a lot of businesses in the last year that weren't actually on the market. Maybe the people in the background were thinking, oh, one day it might be quite nice to sell, but they weren't actively marketing themselves. And then what's happened is someone's knocked on the door with a fantastic offer that they can't actually turn down. And then from there, it's gone into a sale process. Going forwards, whether that will change a little bit. So this is Google Analytics. So it's not perfect data, but it's just quite interesting, matching off against people that have Googled selling a business v buying a business. And you can see there's not really any pattern there at all. They match each other quite closely until you get to the new year of 2021. And there was a lot more people thinking, actually, what does it take to sell a business? So I would start like looking into that, probably because New Year's resolutions, people just had enough. My feeling is that will happen a lot at the start of 2022. People feel like they've weathered the storm, they've done their part, and now it's just time to cash in. So I'd expect that in the early days of 2022, there'll be a lot more seller-driven deals going on and people looking to go to market. This is data taken from a Deal Suite survey. So Deal Suite is like a deal marketplace, and they survey their members from time to time of just what deals they've had going on and what's completed. And this is quite interesting because they say for the first half of 2021 in that left column against the second half of 2020 in the right-hand column, they're saying that deals over 10 million made up a smaller percentage of the actual deals that were going on. And likewise, 7.5 to 10 million was about the same. So overall, there were less deals of over 7.5 million around, and more, as percentage terms, there was more smaller deals. That's quite interesting compared to our deal flow, which I know is quite a small sample. But if anything, we feel that there's been bigger deals on this year, especially towards the middle of the year and the end of the year compared with 2020. 2020 was strange because there was a big part of the year that was disrupted with COVID. But overall, we did a lot of deals completed, but they were of a smaller size compared to this year. So this year's been extremely busy again, but it just feels like for us, the bigger deals have come through this year. So it's quite interesting to see how it differs between region and advisor, in that some other firms clearly felt that they had bigger deals going on last year. So that brings me to our first poll. I think it's the first time we've tried to do one of these, so hopefully it goes okay. But in a second, it should pop up on your screen asking what you think will happen to deal flow. There we go, in 2022 against 2021. So if you could just pick one of those. So if you think there's going to be a strong increase, a slight increase, no change, slight decrease, or if you think that deals are going to dry up a lot, then large decrease. If you could vote now, it'd be quite interesting to see the results. So that's interesting. Then overall, a majority feel like there'll be a slight increase in deal volume, and it's quite a nice positive slant on it, because overall, the vast majority of people think there is going to be an increase, and there's only about 18% that think there's going to be a slight decrease, and no one thinks there'll be a large decrease. So that's quite promising. So going on to our predictions, we weren't allowed to vote in that, but I think my prediction would have been that I probably would have gone between no change and slight increase. I think the tempo will remain as it is at the moment for at least the first half of, I'm not sure why that slide's flicked on there. I'll carry on anyway. I think the tempo will carry on the same as the first half of, in the first half of the first quarter of 2021, the same as 2019. But then after that, it's just a bit too hard to gauge what's going to happen that far in the future, because a lot of things could change, and they do change quickly. I think there'll also be a scope for a budget boom when there is a budget announced. It just seems to be par for the course now. Whenever a budget's announced, people want to get deals done quickly. We're not due another budget until autumn next year, but really, who knows? Not much came out of the last budget, so you could always have the risk of an early year one as well. So moving on to our second area, as the slides have moved on to it anyway, and that's around, I'm not too sure what's going on with the slides. There we go, I think I'm back in control. So our second area is around responsible investing, and it's clear that environmental, social and governance factors, so ESG, is becoming much more important to investors at a listed level. And this is a chart from the FT, it's quite basic data, but it just shows how the money has been pouring into funds which specialize in ESG investments. And really how much that's been accelerating. I know that the most recent data there shows a slight fall off, but compared to a few years ago, it's really going in only one way. And if you were skeptical, you could say, are people really valuing ethics over profit, or are they thinking that these businesses that are alive to these ideas are going to have a longer shelf life, and therefore they're going to attract more goodwill? So is it just savvy investment rather than worrying much if a business is environmentally friendly or whether it does things in a socially acceptable manner? There's been a few articles about whether this will filter down to mid-market M&A, and the way it's gaining traction in listed investments, you'd probably have to say it's probable. So at the moment, I think in this region, we see things that maybe comply with ESG or they've got a nice angle to them, but really at mid-market M&A, it's just driven by profit. So it might be that something's got a really nice niche and it does things well and it's good socially, but people are still driven by money, and it's the angle that, well, if it does all these things well, hopefully it'll be twice as profitable, or it's got a longer shelf life that will generate more profit. I think the interesting thing to think about is where you have larger buyers, like either PEs or larger trade buyers, and they're going to have to show consideration of these kind of factors for their own reporting and for their investment committee sign off and board sign off. So if you have a deal that's got a nice angle there, then that can only help. But in terms of valuations, we haven't seen any impact on valuations where we'd say, oh, this should go off a higher multiple because these factors, this business does really well in these factors. The only time it would attract a higher value at the moment would be if those factors are driving more profit. So that brings us on to our second poll, and it's quite an easy one. It's just a yes or no. Hopefully it goes as smoothly as the first one. So it's just, do you expect responsible investing to feature more heavily in the rationale for deals in this region in the next 3 years? We just picked a number out of the air really, because it doesn't feel like it's going to happen overnight, but it's just interesting whether people think that longer term this is a clear pattern that we're moving towards. So if you could vote, that would be great. Now it's quite interesting. So 74% think yes against 26%. I know it's not a great poll because we've just picked 3 years out of the air really, and it's difficult to know how quickly these things will take an impact. But those numbers are quite interesting because that tallies quite closely with the Deal Suite survey that I saw, where they asked people a similar question. And I think the majority of people feel that overall it's only going one way with these kind of things. So businesses in the longer term are going to have to think about this, especially if they're looking for a bigger buyer or a PE buyer. So that comes on to our prediction really, that we think longer term, it is definitely going to become more important, but it's likely to be more of a slow burner in this region. But you could start to see in the next couple of years an impact on business valuations, just purely if you've got the bigger listed entities coming in, looking at these businesses and these factors, or a certain business does well in these factors, then there might be more demand for these businesses, a bit like how we've seen certain things go up in the last year because certain things are in demand. If there's more competition, then it's more likely that the price will go up. And the point I added on to the end there was I'd expect that we're in our information memorandums for bigger sales going forwards. These are going to be the kind of things that we add to it just to make it easier for bigger buyers to be interested, and just make it clear that this is a well-run business and it's an easier box to tick off. So with that, I will hand over to David.
Thanks, Simon. Just wait. Hopefully I'll grab control now at that point. Thank you very much. So I've got the final three areas to look at. So the first one is multiples. So I'm hopeful that most people on the call understand what a multiple is, but just in brief, it's the part of the business valuation. The two parts to it really. One is the profit that a company makes, and the other one is the multiple that we apply at it to get the enterprise valuation. So broadly speaking, the higher the multiple, the higher the valuation of the business. And really what a multiple reflects is the return on investment that a buyer is prepared to accept, or simply the payback period that they would be prepared to wait around to get their money back for. So observations that we've seen at the start of the pandemic, I suppose it was a bit of doom and gloom really. We felt that multiples may have been volatile. We presented some data in the early part of the pandemic, which Simon pulled together, which suggested that there would be a reduction in multiples, but that we wouldn't see it straight away. There'd be a lag. That's what we'd seen in previous downturns. And let's not forget, economically, this is a huge downturn that we've been in, and hopefully we're coming out of it again. But what have we seen? We've actually seen average multiples across all sectors actually trending upwards, which is not something we would have ever predicted. So it's a bit mixed across different sectors. We're seeing a K-shaped evolution at the moment in multiples. So that really means that the good ones in good industries are going up. The bad ones, or in different ones in industries that are not so well regarded, are actually trending down slightly. But none of it's drastic at the moment, as you'll see from the following slide. Hopefully, if I've got control. Yes. Okay, so the first one we looked at actually is an interesting observation. So average multiples across the UK, according to Deal Suite, currently are 5.5 times profit. So that's something to bear in mind for those of you on the call that advise clients. Obviously, it has to be taken with a pinch of salt because it's across all sectors and all different sizes and types of transactions. But it's often been said that the larger the business, the higher the valuation, and there's lots of different reasons for that, but essentially it's down to risk. Perception being that the bigger the business, the more diverse they are, the better the management are, etc. And that is likely to lead to a higher valuation and a higher multiple. But this data actually proves that really clearly. So if you look at the third blue dot along from the left-hand side, an EBITDA of 1 million, you're trending about an average multiple of about 5.5 times profit. But suddenly if you jump to a 2 million EBITDA, so you double the profitability of the company, you're comfortably sitting above 6. And if you do get to a 5 million EBITDA company, then you're trending above 7. So not only are you making more profit, so you're inherently more valuable anyway, because you're larger, you're going to actually trade off a higher multiple. Again, take it with a slight pinch of salt because it's averages across all industries, but I think that illustrates quite clearly that in valuation terms, bigger is better. And that's something I think you would see consistently in the data, and it's illustrated in the transactions that happened in the first half of this year. Across sectors, there's a huge spread here. You'll see, and this is quite consistent in the data that we've reviewed over the last 18 months. There are winners and there are losers. The winners are not unexpected. So IT services and software development, healthcare, pharmaceuticals, it doesn't take a genius to understand why they are trading on multiples of north of 8. And those in sectors that have struggled, like retail, hospitality and tourism, are trading on multiples of 4 or below 4. And there's some interesting ones in there as well, which perhaps are a bit less obvious, but have always historically had low multiples. For example, construction industry sitting at below 4. Most multiples on that table are trending marginally upwards, only small numbers, apart from 2, retail and hospitality, which are trending slightly downwards. Okay, so there are our observations. What do you all think is going to happen in 2022? So 5 options there. Increase rapidly, marginally, stay the same, decrease marginally, or fall off a cliff. Okay, so the optimism has gone from the polls now at this point. So only 5% of people saying it's going to increase, 58% sitting on the fence and saying it's going to stay the same. And yeah, like I say, a slightly more pessimistic outcome to that poll in terms of more people thinking it's going to stay the same or decrease. So thank you very much for that. That's interesting. So let's compare that to our prediction that we put in place before we did the poll. So our prediction would be that we think there's going to be a general leveling off or stabilization, so not predicting necessarily a fall. We think it will continue to split across sectors. So we think multiples for the most attractive businesses and sectors will continue to increase, driven by demand, increased demand and a lack of supply of those businesses. We think struggling sectors will continue. No big changes or dramatic changes, but something we haven't really seen yet is many transactions involved in distressed companies. Distressed companies have largely been able to keep going because of a mixture of largely government-sponsored initiatives, including things like CBILS and other things like furlough. But we think that as those businesses start to hit a greater degree of distress, those opportunities to buy those businesses will come forward. So probably an opportunity for stronger businesses to get stronger as a result of those acquisitions. So it could be a good time to buy. So leaving multiples aside now, moving on to types of transaction and starting with our observation again. We've seen a shift in our deal flow over the last year, quite a significant one, and again, not one that we would have necessarily predicted back in April 20. We've seen many more deals involving private equity in the region, probably more deals involving private equity in East Anglia than we've ever seen, that's for sure. And as Simon mentioned earlier, a large number of trade buyers as well have been involved in transactions that we have. We've seen more employee ownership trusts being used as vehicles to sell businesses and also obviously move them into employee ownership, and fewer MBOs, fewer management buyouts. Management buyouts have long been the mainstay of what we've done and lots of other advisors have done in the region, so it's been a definite shift in trend. We've also seen fewer transactions requiring us to raise funding. And we think that's probably almost certainly because of existing liquidity in businesses, maybe fueled by some of those government-sponsored loans, for example, like CBILS. So just looking at that in data terms, just under half of our transactions were involved trade purchases. The next sort of 30% were PE. And then the next 2 lots of 10% were EOT or MBO. So I think if you looked at that data, we haven't got the comparison here, but if you looked at that data in 2019, EOTs probably didn't feature. Although they've been around since 2014, they've become much more popular of late. And MBOs would have dominated that chart, certainly probably at the expense of private equity deals. Some of the PE deals will have an MBO element to them, but we've classified it in this way just to illustrate the point. Okay, so moving swiftly on to the next poll for this section. So do you think that debt funding for acquisitions will be easier or more difficult to achieve in 2022. I appreciate there might be some debt funders on the webinar, so see if they're optimistic or not. Okay, so a bit of a split one, this one. So it's difficult to make some analysis from that. So we've got 37% saying more difficult, 37% saying stay the same, 26% saying less difficult, which is interesting. Difficult to pull the bones from that one. Let me just grab control of the screen again. So our prediction was obviously partly to do with funding, but starting off more widely in terms of types of transaction, we think that private equity and large trade buyers will continue to be active. There's still considerable liquidity in both of those buyer types, and therefore we're not seeing any let up in that demand at the moment. We do think that management buyouts will see, when we've used resurgence, perhaps that's too strong a description, using secured funding and deferred structures. So that's what we might have traditionally called the debt and deferred MBO, which has been very popular in the region for small and medium-sized deals that don't fit trade for whatever reason. They don't fit PE, and that could be because of size or industry, and for whatever reason don't fit an employee ownership trust. And that's an important point. Lots of businesses don't fit or suit EOTs. They can't be used as a substitute for an MBO, but they do work really well in the right circumstances. And we think MBOs will come back partly because management teams are more confident. 2020, certainly early part of 2020, may not have been the time that you'd have looked to initiate a conversation with the owner of the business about taking that business on as an MBO. But now, as people are a bit more confident, they can see where business is going, they may look to structure those deals. And also linked in with that, the point that Simon mentioned earlier, that owners may be looking at this time, maybe early 22 after Christmas, when people have had time to think about it. Are they worn out, or are they actually just going to take the opportunity to put their business on the market at that stage? So the final area that we're going to look at today is payment terms. And we've talked about this before, but I think it's worth reiterating it again, because there has been quite a change here over the last year or so. So we've talked about multiples, they're remaining quite strong, different in different industries. But as a result of multiples holding up, what we have been seeing is buyers looking to mitigate their risk in other ways, driven partly by the fact that we haven't talked about it today, but we have on other webinars. Earnings have been quite volatile in 2020, 2021. Some businesses have done really well through COVID, some have not done so well. So actually establishing what is real earnings has been really, really difficult. So buyers have looked to mitigate their risk. And whilst historically it would have been drilled into us to be talking to clients probably around the fact that if you receive 75 to 80% of your consideration up front, that was a reasonable deal. Now it's really not uncommon to see 60% of your consideration up front, maybe 50% of your consideration up front. So just to illustrate, there has been a shift there, not in all deals by any stretch of the imagination, but we've certainly seen this as an observation. It was coming pre-pandemic, but it's certainly been even more popular post, and it's a way for buyers to reduce their risk. Clearly, it almost goes without saying, but the more money that's outstanding, the more risk a seller takes. It's often been said that the amount of money you get on day one is the only bit that you can be sure of, and that's absolutely true. But there are opportunities as well. So whilst we talk about deferred consideration, it can take many forms. It could be retaining shares, it could be looking at straight deferred consideration, it could be an earnout. There are upsides there as well, potentially in most transactions. I thought it was also worth mentioning that greater preparation leads to better day one outcomes. So the more you prepare for a sale as a business owner, and that could be bringing on a second-tier management team. That's probably the most obvious one. Taking yourself away from the business day to day is clearly one of the bigger risks that a buyer might look at if they're looking to buy your business, how much of it's locked up in the goodwill of the owner or the owners. The other one might be if you've got one single customer, which accounts for 50% of your business. Again, it's a risky business to buy. So more preparation that you can do in advance will lead to better day one outcomes. Not only will you hopefully sell your business for a greater price, you should get more of it upfront as well, which is what you're looking to achieve. So the final poll is to look back at deals that you've been involved in. Hopefully those on the call have seen some transactions. If you haven't, you can have a guess. But what is the average time span for deferred payments or earnouts? 0 to 6, 6 to 12 months, 13 to 24 months, 2 years, 3 years, or over 3 years. Okay, so nobody 0 to 6 months, a couple over 3 years, from the rump of them between 6 and, well, somewhere between a year and 3 years. With the biggest balance in 1 to 2 years. Just to the last bullet point there really is actually concludes exactly with what people have just said. We see on average deferred periods of between 1 and 2 years. We do see things at all extremes. Over 5 years we've seen, none at all we've seen, but 1 to 2 years is pretty typical. So what that means is that our clients, people that you're advising and we're advising, need to plan longer if they're looking to actually physically exit a business. You can't think that the day you drop off the keys, as it says there in the second bullet point, is the day you walk away from the business, because almost no deals will involve you taking all of your cash day one. Very, very few. So it's just bearing that in mind when you're talking to people who are thinking of selling their business, that actually planning for that earn-out period or that deferred consideration period is equally as important in their timeline. We think the trend for increased proportion of deferred consideration will continue whilst there's uncertainty. There's still uncertainty in earnings. They still remain volatile. Understanding what true profitability of a company is post-COVID is still to be proven as results in 2021 and 2022 and even 2023 come forward. So that's the formal content section of the webinar complete. We looked at those 5 areas: deal volume, responsible investing, multiples, transaction type, payment terms, in some detail, looking backwards and then estimating to look forwards. We thought that was quite topical given where we are in the calendar year. I think probably just reflecting on those, we started quite optimistically. So 77% of people thought that deal volumes were going to increase. People thought that responsible investing was coming, but slowly, and that agreed with our conclusion. We started to get a little more pessimistic or less optimistic when we talked about multiples. Transaction types and payment terms, again, in line with our predictions for 2022. So do we have any questions? I don't think there's any sat in the actual Q&A unless I've missed them. Oh, I think one might have just arrived. Okay, so that's a good question. So the question is, how do you value a business now where through COVID profits have dropped? Do you want to answer it, Simon, or do you want me to answer it?
I had a feeling that was coming my way. I think the main thing is how confident you can get that it is going to recover to how it was before. If the profits have really dropped off and there's no no evidence that they're going to recover. You might have some forecasts, but if they don't look very plausible, then it becomes very difficult to value on data from a couple of years ago, because the world has changed. And equally, you'll have businesses that are absolutely flying now, and they're not going to, they're going to want a higher price than they would have a couple of years ago. So things have just changed, and I don't think it's necessarily that you should just go back to, or things are getting back to normal, so let's value based on 2019. I don't think you should forget the period in between. Obviously, it differs by sector a little bit, but I think in general, you should be getting a decent run rate now of being able to see where you actually are. And if you want to disagree with that, David.
No, I agree with it completely. I think it's probably also worth saying that it's not just a situation where through COVID profits have dropped. For, a lot of businesses have actually increased as well, haven't they? Either, not necessarily the direct result of COVID, but we have to take that into consideration. There's lots of technical ways that we can look at it. So a business that's received a lot of government support, furlough, for example, there's a question mark as to how you deal with that in evaluation, and whether you consider that to be a recurring or a non-recurring item. So some technical answers to it, but I think generally Simon's absolutely right. You've got to see how and if that business has recovered, and the best way to do that is to look at the current data. Do we have any more questions? I don't see any more popping up for now. You've got our contact details, hopefully. If you'd like to reach out to us and talk to us about anything that we've covered today, we'd be more than happy to do that offline. Thank you, everyone else, for joining us today. Thanks, Simon, for your input. It's really helpful. I'd just like to say a goodbye to everyone. Thanks for joining us. There are 2 other Team of Experts webinars coming up over the next couple of weeks on forensics and business recovery. So if you haven't joined up for those already and it's topical to you, please have a look at our website and you can join up for those webinars there. So thanks very much. Final goodbye.
Thanks all.
Thanks.